This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to the Fintech Takes podcast. Today is a very special episode, a guest episode. In fact, we have one of our all-time favorite returning guests to the Fintech Takes podcast. You know him perhaps as one of the voices of the Breaking Banks podcast, the co-founder and CEO of Alloy Labs, a man who walks with a foot in both worlds, Jason Henrichs. Jason, thank you for coming back to the Fintech Takes podcast.
I know you're making fun of the fact that I did so poorly in my early entree that you did not invite me back for years.
That's not true.
Years.
That's not true. You did such a good job in a live podcast recording. In fact, the only live podcast recording that I have done as a part of the Fintech Takes podcast, that I just didn't feel like it was worth bothering you until I could give you an adequate stage to come back and really, surpass the great podcast that you did the first time. So all jokes aside, Jason, as always, it's delightful to talk to you. It's delightful to have you on the podcast. How are you doing, sir?
Well, I think we are both fired up. So it is going to be an interesting take today.
Yes. For listeners, just as a little bit of context, Jason and I are a part of several different text chains and direct messaging groups. And so we've been bouncing a lot of things back and forth, particularly over the last couple of days, based on some stuff that's happened in the fintech ecosystem that has us all fired up. So this is going to be part therapy session. This is going to be part sort of big picture prognostication. So the plan for the podcast is that I have asked Mr. Henrichs to come prepared with a list of 2 to 3 big picture questions about fintech. And this can be anything in the wide world of financial technology. I have a hunch, based on offline conversations that we've had, some of the hot button areas that he may bring up. I have brought a couple of questions myself about the future of fintech and some big picture questions that I'm thinking about. And we'll just take turns talking through our questions and seeing where we don't overlap. Mr. Henrichs, as the guest today, I will give you the honor of submitting the first question. What do you got for us?
Well, I actually need to talk about our sponsors first. So the first sponsor is brought to you by the letter F.
Oh, wow. Jason's got a prop.
The second sponsor is brought to you by the letter A. Next sponsor is the letter F.
Mm-hmm.
Last sponsor is the letter O. FAFO.
FAFO.
Also known as the F around and find out curve.
Wow.
And that is how Jason is going to talk about this week in fintech.
Amazing.
So this is Jason's FAFO episode. And I want to start with what I want to make absolutely clear. I think banking as a service is absolutely essential.
Yes.
I think it created access to banking services for lending and deposit accounts for populations of both consumers and businesses that were totally underserved, but not without hiccups. And it took pioneers, and one of my favorites, the fact that sometimes pioneers end up dead on the side of the trail with dysentery, right? And those that needed to persevere, right? Like the banks and the fintechs that have powered through on this. However, there was a massive influx of venture capital starting in 2010 that really hit its stride in 2016 when 1 in 5 venture dollars went to fintech.
Is it?
And I think the first important point is banking as a service is fintech, but not all fintech is BaaS. And one of the issues the regulators can't seem to pick up is that nuance that we talk about fintech. It is not all banking as a service.
Yes.
And I think today what we're really driving into is that banking as a service part of this. So when we're saying fintech today, we really do mean the programs, and programs a very precise word, which are those startups that are the customer-facing entity. And I think the influx created, you talk about one of my favorite phrases from you is BaaS Island.
Yep.
One of mine is fintech tourism.
Mm-hmm.
And what we found is in a ZERP world with way too much venture flowing into this, we had too many tourists. And what I mean by that is entrepreneurs that saw problems they thought needed to be solved, but had no experiences in financial services.
Yep.
VCs that thought because they worked in finance, and because let's face it, VCs are experts in everything, they could understand financial services. Banks that saw BaaS sponsorship as easy money but didn't understand the investment. And last but not least, regulators that took the wait and see approach. And so the first question I want to ask for us to workshop here, there are a large number of programs, again, the precise word for this startup serving customers, that picked a bank based on convenience and their willingness to be flexible.
Yes.
As you had said in your essay around, hey, evolve, feature not a bug, when it comes to skirting some of this. But right now, these banks are under pressure to either invest in, to shore up their programs, or divest of their BaaS programs. And it's about to orphan a large number of consumers depending on those services.
Yes.
Doubly impacted by the fact that the wave of startups that were able to raise a large sum of money at probably too high of a price that don't have real business models. We have a 1-2 whammy of tsunamis of programs that are about to blow up. So the question becomes, what happens to these consumers?
Okay. Well, this is a great question. And just to add a little bit of kind of current context, and by the time folks are listening to this podcast, it'll be about a week old, but this should still be sort of in the news. We're seeing some of this already, right? We are seeing bank partners essentially passing down stricter requirements to the programs that they currently manage, saying that, we might have allowed you to onboard these customers originally. Our understanding of AML requirements, our understanding of KYB, our understanding of customer information programs, that has changed. It has evolved. And now we have a different definition of how this needs to work. And I know Jason Mikula, our friend, would love that if he finds himself using evolved a lot in sentences. That has changed. And now you are going to be required to close a certain number of your customers' accounts. And the example that's top of mind for me today is Mercury, because we are seeing the B2B neobank Mercury offboarding a set of its customers. It seems as though mostly it's geographic. So if you are either based in or have information associated with your business or its principals that are in certain geographies like Nigeria or the Ukraine, you are being offboarded of Mercury. Now, of course, some of those are probably going to be accounts that never should have been onboarded in the first place. Some of them are probably going to be legitimate customer accounts, though, that are high risk, but are legal to be banked and should be banked by someone. And I think you ask a really good question in terms of where those folks go. I don't know the answer to this, right? Because I think the challenge that I have with fintech and its sort of exploitation of how BaaS has worked over the last 5 years or so is not only did they come into the market and say, we're going to compete with banks, but the other thing they said was, hey, large group of consumers and small business owners who have not gotten as much access to the banking world as you should have gotten, we're here to save you. We're here to help you. We're here to say yes when other banks say no. Yeah. And I think, we toss around the term democratization a lot in fintech, but essentially that was those fintech companies making promises when they didn't really know what the hell they were talking about, right? They didn't have an accurate understanding of how difficult it is to bank in a legal compliant way someone who's starting a business in the US but has a Ukraine-based passport, right? They had no idea about how difficult that would be and kind of the tightrope that you have to walk in order to do that in a compliant way. And so the promise that they made to them originally, yes, you can come in, you can have the same smooth, frictionless onboarding experience that everyone else has. We're not going to flag any of your transactions or as high risk or monitor them or hold them for review. That experience was a lie, essentially, and it wasn't something that you could deliver in a sustainable way. And I think that's the thing I'm really wrestling with is, these customers have a very real right to feel burned by that experience.
Yeah. It's funny you bring part of that up. So going into the Wayback Machine here, funny backstory on this. So co-founded Perk Street, one of the first challenger banks in the world, 2008. I think people know that part of history. I had come from venture capital before being at First Marblehead, the private student loan company. So, of course, we banked with SVB. At that point, started working with SVB in 98. Risk came back. Now, this is our corporate account, not us on banking as a service. We are still trying to figure that out. We closed our Series A with Highland Capital. The first $3 million was deposited at SVB. I get a call from our relationship manager saying, risk and compliance is a real problem here. They think you're a money service business. And even though we're holding your corporate funds, not acting as your bank partner, that could have blowback for us. So the funny thing is, we got a 24-hour heads up because Highland was actually trying to actively pull the money back. We closed our round April 19th when the Dow plummeted, led by the financials, right? Like that's when Lehman announced that they were going under. WAMU was being shopped. It was horrible. And Highland was just going to pull the money back. And so Silicon Valley Bank said, you have 24 hours to go find another bank, right? The irony here.
Yep.
And so we were in downtown Boston. Dan went left down State Street. I went right down State Street. And we went door to door looking for a bank that would take us. And it ended up being B of A because we told them we were a marketing services business.
little creative application villain, not a big deal.
Little creative.
Yeah.
But the question becomes, like, it's not going to be as easy this time
right.
to go do that, because I think one of the biggest points that you just made is it should have started with a tighter lens. The filter should have been tight and then widened, as opposed they started wide and it's like now we're like, oh, we may have been fast and loose with some of this. Maybe we need to, button it down. And I think the opposite is actually true. This idea of move fast and break things doesn't work in fintech. That trope gets played all the time around move fast and break things. So one of my least favorite tropes is always we're going to take the Uber approach and move fast, break things, regulators will catch up. Does not work when people's livelihood is at stake.
Yes.
And I think one of the challenges is you ended up with a bunch of entrepreneurs who overestimated their technical capabilities. A bunch of banks that overestimated, hey, we do risk and compliance really well, but thought about it in the scope of their existing business and did not understand not only was it now a channel partnership, but that channel was going to also be growing exponentially. And when you add that the risk of the first item, right, which is people that don't necessarily understand financial services or do know financial services, I actually can think of several well-known fintechs that have founders that come from this space, but we're doing something new with it, and it begins to explode. And I don't want to, let the regulators off on this. I think one of the biggest problems is regulators took a wait and see approach to this. Yeah. And this is like the heart of, you want to FAFO on this. If you wait too long to intervene and don't correct minor problems, it leads to major problems.
Yeah, I totally agree. I mean, and I'll just say the acronym in its full glory. Everyone has been fucking around and finding out, right, with banking as a service. And I think to your point, the thing that's really interesting is it kind of took everybody taking that approach in order for the worst case version of all of this to manifest itself, right? I was talking to somebody else the other day about like, what's the worst case scenario for how banking as a service could unravel? And pretty much it happened, right? Like you would take marquee fintech programs, you would take the largest single sponsor bank in the US, you would take one of these banking as a service middleware platforms that has a particularly complex model that intermediates different parts of the stack, and you would take them all together, and then all the worst parts of those would all express themselves simultaneously, including a data breach. So all of that happened. And I think you're right about regulators in terms of not letting them off the hook. And in fact, that brings me, Mr. Henrichs, to my first question. Do you mind if we segue a little bit?
Can I intervene for 1 second?
Please
I have a funny backstory on this. So I've railed on FBOs, for beneficial ownership accounts, for a long time.
Before it was cool.
But Key and I had talked about this. So a regulator had found me talking on a podcast 6 years ago. And I said, one of the big problems with the FBO is one of the three major requirements is accurate record keeping.
Yep.
Right? The whole reconciliation. Like,
Yeah.
but imagine if a bad actor like Russia hacked the bank.
Yes.
So I got this phone call. I was like, what did you know? I'm like, I thought I was being funny.
Right. It's hypothetical. Funny hypothetical.
Funny, ha ha. All right, your first question.
Man. Well, no. So that's a perfect segue because the thing that we've all been talking about, but I don't think I've talked to you on a podcast about directly, and I want to ask this in the sort of broadest way possible about the future of fintech. Mr. Henrichs, what's the right way to regulate fintech? Because I think, just to put some sort of bumpers around this topic, the idea that consumers shouldn't use fintech is preposterous and stupid and should never be said.
Genie cannot be put back in the bottle.
No. And it ignores, as I think we've been talking around, a lot of the good things that fintech and banking as a service have done, right? And so we want these types of experiences and products and, just like focus and attention on certain customer segments. We want that in financial services.
Yeah.
That's a net benefit to financial services. So the answer cannot be don't work with fintech companies. And then within the wonderful dual banking system that we have, as I have written about recently, there are strange and conflicting forces that clash up against each other in ways that the average person might not fully even appreciate or observe. But those are also things we have to work around and work within. So within those constraints, which I know you understand very well, having lived in this world for decades, what's the answer? How do we regulate fintech?
So this is probably going to shock you.
Yeah, I'm shocked.
I don't know that a fintech charter is the right way to go.
That's totally fair.
I don't know that we can figure it out.
Yep.
Like, I see merit to the CSBS, Conference of State Bank Supervisors side of like, hey, we need pockets of bank charters within states that can do new and different things before they expand.
Yeah, move faster, right? Because like national regulators, as we've seen, they don't move fast.
No, do not move fast.
Right.
Here's what I think the right model is. I'm showing my age here. For people who were in venture in the early 2000s, there was a move on the London Stock Exchange in the AIM that you could go public on the AIM, but the way they did it for these small venture-backed companies that weren't big enough and profitable enough to get investment banker interest to do NASDAQ or New York Stock Exchange. And the way they did it is the FCA would basically regulate, you had to pay an investment bank that was your proxy regulator, and you could go public on the AIM. And what ended up working exceedingly well, right, is the investment bank in the middle avoided the adverse selection process, because if they screwed up and did not properly regulate you, they lost their entire business. And we're close to this. Like, we're very, very close to this. We're just not explicit about it, about what the state is. Here is the regulatory guideline that you need to meet, the burden of proof for how you act as a sub-regulator for us. And even if the fintech is paying, and this is where I think we screwed up in the US around this, is, the fintech can be paying you.
Yeah.
But your business is dependent on you actually making sure they're compliant.
Yeah. So like enough revenue that it gives me a financial incentive to do it, right? Because that's what you worry about in banking as a service, is regulation reaching the point where it's just not financially worth it for anyone to do it. So someone has to like provide oversight and have a financial incentive to do that, but with severe enough consequences if you screw up that you do it in a careful way that selects for responsible entrepreneurs.
Yes. And this is a very frequent conversation among our banks and the Banking as a Service Center of Excellence at Alloy Labs.
Yeah.
Is around pricing.
Yep.
Because you have a number of banks that don't understand the full cost of administering a program.
Yep.
And just as in the ZIRP days, you ended up with programs trying to negotiate compliance items and oversight. You're like, these are non-negotiables. Of course I have to oversee your marketing.
Right.
Of course I have to see your complaints. Like, those complaints are literally my complaints. It's my charter.
Yep.
If banks don't understand what it costs to administer this program, they're doing one of two things. Best case, they're a loss leader and they're like, strategically, we want to own this and therefore we're willing to take a loss. Or two, the more likely, they're cutting corners.
Right.
And so the banks that are doing it right, which there are a great number of banks that do this right.
There are.
Right. And totally necessary. We have an upcoming episode on breaking banks with Gilles Gade from Cross River talking about consent orders.
Yeah.
Are stepping stones, not stumbling blocks.
Yep.
Right. He looks at it, he goes, our mission around this has been, how do we actually extend credit to parties that otherwise would not have access to it? He goes, we're the ones who surfaced. There was a fair lending issue.
Yep.
We found it. We own it. We're putting in a whole new set of controls around it.
Yep.
But it's upwards and onwards because we have the mission.
No, I think that sounds right. I like that model in terms of aligned incentives. And, I think the other thing I would just sort of layer on to what you said that is something I didn't really fully appreciate until all of this broke down the way that it has is I think there is a big distinction between consumer protection and safety and soundness, right? And so when you were saying before about regulators were sort of waiting and watching and waiting to see what would happen, they were waiting and watching to see what would happen in terms of what would break with, I think, a decent comfort level that the banks that were involved in this, if it was to go as bad as possible, it still probably wouldn't pose a safety and soundness issue for the U.S. financial system. And so one of the things I've been troubled a little bit by is, when you see like the FDIC, for example, talk about the Synapse failure, they talk about it more in the language of, well, there's been no impact to the insurance fund, and this isn't posing a risk to safety and soundness of the U.S. banking system. So from our perspective, and they don't quite say this, but like you can read between the lines, this isn't a failure, right? Like nothing got broken here. Like this is fine. And of course, anyone who's not solely responsible for that is looking at it and going, what if, of course it's a failure, right? Consumers are having their life savings locked up in these apps that they can't get out. And so I do think drawing a bit of a distinction between when you talk about like the worst case and, hey, if you screw this up, bad things can happen. The penalties and the downside need to be linked, I think, to both consumer harm and safety and soundness, not one or the other, which I think has been kind of the weakness of a lot of regulation at a federal level, where it's either the CFPB, which has a set of concerns and a way of looking at the market, or it's the OCC, FDIC, and Fed, and they have a different way of looking at it. And really what we need in terms of disincentives is a blended model where both consumer harm and safety and soundness are equally bad outcomes that as the administrator of these programs or the sponsor, you want to avoid.
Well, let me pin those two things together.
Yeah.
The first is, I find it ironic that the FDIC in particular is taking this wait and see, step back response. Yeah. But has been very active about the placement of the FDIC logo and the terminology.
Yes.
Like those two, like, no. We all knew FBO was going to be an issue. We all knew that things could go wrong.
Yeah.
And I think those who are steeped in it are, also very clear. It's like, hey, unless the bank fails, FDIC insurance doesn't work.
Right.
Yet the FDIC is letting all of the startups, myself included, mea culpa on this, right? Like we advertised at Brook Street, FDIC insurance. Our difference was we had a one-to-one relationship that every account was an account on Fiserv.
Right.
It was ultimately part of our undoing because the unit economics do not work. Not talked about enough. Everyone's like, oh, like the cores aren't, set up for this kind of technology. No. The cores are actually basically not willing to give up on, their pricing. Economics.
Yeah.
Right.
Yeah.
So they're like, no, we paid 65 cents per account, whether someone used it or not every month.
Right. Which kills you as a startup when you're just like, a little side piece to a consumer that they're testing out like that destroys your unit economics.
Yes, exactly. And so this approach that the regulators took around, hey, let's take a wait and see until it plays out has now become a much bigger issue that they're trying to stuff back into the bottle. And it's like, no, you saw it. You dabbled on the edges of it.
Yep.
But you should have gone in and more active sooner. And I think when you look at the best banks that do banking as a service, they're the ones, despite not having regulatory pushback,
Yeah.
invested anyway.
Yes.
And then you had a host of banks that said free money,
Yep.
jumped in.
Yep.
And so I think the thing to pin together what you talked about is how do we regulate this is you actually need regulators that are going to be more prescriptive than they are normally comfortable doing to say, here's what we think safe and sound looks like. Because the problem is the consumer does not actually distinguish when it said FDIC insured.
Yeah.
They don't understand that Mercury is not a bank.
Yep.
Aspiration is not a bank. Chime is not a bank. It said FDIC insured. So the safety, and I know Kia Haslett from bank director, and we're part of a group that we fight about this all the time.
Yeah.
Yes, legally you can say the safety and soundness of the banking system is not impacted.
And she's a big buyer beware person, like, read your terms and conditions, which I'm generally sympathetic to. But I mean, you and I have read these terms and conditions. Like, I can barely parse what the terms and conditions of a fintech program are and what it means in terms of what's covered and what's not. I mean, it's ridiculously complex. There is no rational expectation, I don't believe, that a consumer can or should be able to parse that. And to your point, in terms of regulators being more prescriptive, the other thing that I think is really interesting is, as you said, regulators aren't comfortable being prescriptive because the more prescriptive you are, the more you are locking yourself into a set of rules that then people can find creative ways to get around. So you don't want to be prescriptive.
Or you're held accountable.
Right. Like you said, this was the safe way to do it. And now look what happens. So you want to be vague if you can be. But like just as another example of this, even when it's the bank failing and not the fintech company. So let's say kind of a reverse synapse where it's not, the fintech program that gets all kind of locked up or it's middleware provider, it's the bank. Even in that scenario, FDIC pass-through insurance, which would pass through to the individual programs on that bank, that doesn't necessarily apply if certain conditions aren't met. And you only know that after a bank has failed and the FDIC goes in and examines the records and how everything was structured. And then they determine if FDIC insurance is passed through or not. And so to your point about like consumer awareness and how do we help consumers shop, like, is this a good fintech or a bad fintech? That's ultimately the question we need to answer. And unless like there's an FDIC stamp on there that says FDIC pass-through insurance, if the bank fails, will apply in this case because we have proactively looked at the arrangement and the way that records are kept, and we feel comfortable with that. And there's some level of protection or guarantee on the fintech failing. Absent those things, I just don't know how consumers are supposed to make this choice.
Well, and this goes back to the fundamental nature of the banking system is a purveyor of trust.
Exactly.
And this is putting ambiguity into that trust system. And so where Kia could argue, hey, legally, there is a line here that they do not oversee the fintech, which I agree with.
Yeah.
Legally, she is correct. But safety and soundness in the system, the number of times I have sat in meetings with executive teams of banks, with regulators, talking about reputational risk.
Yeah.
This is reputational risk, but it is on the regulators for the first time. And so their reputation on safety and soundness is at stake.
I could not agree more. That's a perfect way to put that. All right, give me your next question.
Oh, man. So we have a whole bunch of entrepreneurs discovering financial services are hard.
Yeah.
I find it ironic that many are trying to be thought leaders saying, we never thought this could happen. Your job was to actually understand this could happen.
Totally.
Or I did software before and this is harder. Should entrepreneurs and their investors and boards be held personally accountable?
Well, we are so aligned because this is very similar to a question I have coming up in a minute. I think that is a great question. And generally speaking, I would say yes. And by the way, just so we're clear, I think this is true on the bank side too, right? And so generally speaking, the way that regulation has worked in financial services, individuals don't tend to be held accountable for this stuff, right? I mean, we saw this during the great financial crisis. Most of the folks who played a starring role in that didn't end up being really held personally accountable. I think there's maybe one person who went to jail and served a very short sentence, but there's very little personal accountability in financial services, just generally. And I think that should change. And in particular, you bring up investors. I think investors are like the great part of the story with all the stuff that's been happening with BaaS and fintech generally that hasn't really been talked about that much. Our friend Jason Mikula talks about it from time to time. But where's the discussion about who the investors are in these companies and what role they played on the board of these companies in terms of overseeing some of these decisions? And again, just hearkening back to some of the specific examples, a lot of the stuff that happened with Synapse and with the fintech programs that were built on Synapse, two things are true. One, a lot of the investors overlapped between Synapse and the different fintech programs. Mercury and Synapse have a very similar board. And two, there just has really been not very little discussion at all of what type of oversight or mechanisms were in place to prevent some of these decisions from being made. And I don't know that there's really any like legal or regulatory framework to unwind that or to ask those questions. I mean, I think the only way you'd ever find out even is if we dragged some of the investors up in front of Congress and had a hearing about this to try to find out kind of who knew what and when and how this all happened. But absent it rising to that level, which Synapse and Evolve kind of have, I just don't see any way that that can happen right now. And I do think that is a problem because if you had more personal accountability for this stuff, it's funny we're talking about this. I was talking to someone who was the ex-chief compliance officer at one of these large fintech companies that's been kind of tangentially related in some of the stuff that's been happening. And they were saying that if they were personally held liable for the decisions that their fintech was making on compliance, they would have left a year earlier than they ended up leaving. And so like a very tangible example of if I knew I personally was on the line and I knew that the things I was trying to get done and recommending and pushing my CEO to do, and that he was saying no to, if I knew him saying no to that meant there was a meaningful odds that I would get fined, that I would get banned from working in this industry again, that I might be held criminally liable for something, that would completely change the calculus in terms of me being willing to continue working there, where I take my next job, how I evaluate which investors are investing in which fintech companies. Like, I think it would have a huge sorting effect on, a bank wants to work with this fintech company versus this fintech company, or talent wants to work at this fintech company versus this fintech company, judged based on who their investors are. Right now, the only criteria we use for who invests in a fintech company is brand recognition and name recognition. Like, oh, they got a big VC firm on their board. That's really cool. Like, there should be a different set of standards. So short answer, yes, I think more accountability on a personal level makes a lot of sense. What's your answer to your own question?
So pre-2016, there was a ton more personal accountability, right? Like you did actually see in the S&L crisis, board members of banks and the savings and loans go to jail.
Yeah.
Or be personally fined. Deanna and I talked about this when we had to wind down FAFO Street, is how do we do it in a way that we don't get banned from the industry in 2013?
Right.
Like it was a very real fear for us, right? And we had to figure out a way to go do that. Like it was one of the hardest things was when Dan Rosen left Highland, he was the one venture investor we had that fully appreciated this is people's livelihood.
Yeah.
Right. That we held in our hands. This is how they pay mortgages and daycare and put food on the table. Mm-hmm. You don't just mail them a check.
Right.
Right. Like that's a big thing. And the same is true of healthcare. I think financial services and healthcare are the two places where the executive teams and the boards need to be held accountable. Maybe not all investors, right? But if you are on the board or you are a major investor, you need to be held responsible. And so I've done diligence for dozens of VCs looking at banking as a service and fintech more broadly. And the number of times I would get poo-pooed on, they're like, the compliance, those are semantics. Like, no, compliance is not semantics. No. You don't say a bill pay as a check. Those are covered by different regulations. They mean different things. and they mean different things in terms of the protections to the end customer. And you need that level of expertise and nuance. And I think the accountability, right? Like it brings back the incentives need to be aligned, which is, yeah, scale, but not scale at all costs, right? Like scale responsibly, not, some of the programs we're looking at now, it's like very clear. They knew they were letting criminals into the system.
Yeah. I totally agree. One, it's funny, right? Because money laundering is one of those ones that people in fintech seem to not take seriously, which I find really strange. But it's part and parcel of the larger issue, which is if you don't take compliance with money laundering requirements seriously, how can I be expected to think that you take any part of what you're doing seriously, right? And this kind of goes back to what I wrote in my newsletter about Evolve. Like, obviously, cybersecurity incidences, data breaches can happen to anyone. They do happen to anyone. But if you had to sort of rank order which companies would be more likely to experience a data breach based on perhaps insufficient cybersecurity investments, policies, procedures, technologies, you would rank the companies that don't do well at other things like compliance higher on that list, right? It's not a coincidence that you'd be more likely to have that type of an issue. And so I completely agree. I mean, it's one of those areas where more accountability from the top down will trickle down in a way, I think, that will just cause all of these organizations to be more serious. Now, does that discourage a certain number of entrepreneurs from trying their hand in fintech the first time? Yes, probably. Is that a bad thing? No, I don't think so. I mean, it goes back to your tourism point, right?
Well, in little known fact, showing the age again, there was a major bank in the prepaid space, ended up getting consent order because their insufficient KYC led to the 9/11 tourists, or 9/11 terrorists rather, used prepaid cards issued by this bank was how they purchased airline tickets, moved money around, and did all of this. Like, it's easy to say AML, like under the covers, like you have to do, a SAR. No one ever hears the response to it.
Right.
It just feels like there's like no meat
feels
to
like
what they're
busy
doing.
work for no point. Yeah, right. But it actually does.
But there
have
are
a
real consequences.
Totally. No, I could not agree more. And I do think healthcare is a really good parallel for this, right? And like doctors can be sued for medical malpractice. And that level of accountability ripples through that entire ecosystem in a way that is, I think, a net benefit to healthcare working in a responsible way. Let me run my next question by you because it's actually very closely related, and I'd be curious for your take on it. So, riffing on the investor point just a little bit more, my question is, should venture capital investors in fintech hire more failed entrepreneurs as investors and fewer successful entrepreneurs as investors? And my rationale for asking this question is, I was thinking about, again, exactly what we were just talking about. You have a board, you have investors on that board, they have experience in financial services and fintech. This person founded this company and they had a great exit. And oh my God, look how amazing this is. I've sort of come to believe, and given your background, you'd have a very specific.
As a failed entrepreneur, thanks for
yes.
that up.
As someone who's killed something, to borrow from our other podcast, I kind of feel like success in venture-backed startups, the only thing that tells you for sure is they benefited from good luck and good timing. And it's not to say that they're not smart or dumb. It's not to say that they're hardworking or not hardworking. Likely they are smart and hardworking. But the only thing you know for sure, if they had a really successful exit or they went public or they had some great thing that looks great on a bio on a venture capital firm's website, the only thing you know for sure is that they benefited from good luck and good timing. And I don't know that that group and selecting for good luck and good timing is selecting for the right experiences and knowledge that can be used to guide people who are building in fintech today.
I think that is such a great nuanced question, because I do think, this is what I know from having successful entrepreneurs and CEOs on my board. Is they think they know the playbook. And you just need to go do what I did before. Because I was lucky and successful, right? The timing was right. The luck was right. So just go repeat that. And so their pattern recognition is all wrong. They don't look at the world as what has changed from before that this may or may not be correct.
Yeah.
And so I do think the entrepreneur that is, hit hard times, had to think about it, is much more responsive to the market and ecosystem, right? It becomes a growth versus a fixed mindset to, quote Carol Dweck, right? Like, I think the entrepreneur that has failed has much more of a growth mindset in terms of like, what have I learned from this? How do I adapt, overcome? And one who's successful is like, I know it all. I don't have to do it. So I'd say like, if I look at the banks and startups that I think are in the most trouble are the ones that have the most hubris. Was actually having lunch today with one of my favorite banks that's playing in the BaaS space. Tons of humility, not just with him, but organizational humility around, hey, we need to keep working on this. We're not done. Had that actually as a conversation earlier this morning with another one of our BaaS banks where they're one of the best run banks, I think, as it comes to banking as a service, and incredibly humble, saying we don't have it all figured out.
Yep.
The ones that I see that are problems are the ones it's like, that's not a problem for us. Air quotes, technology, or air quotes, we're good at compliance, right? Like, you can't cry uncle if you're a lineage bank and be like, we're a small bank of 48 people. Why are our customers five? It's like, you have 48 people in your bank. Maybe you shouldn't be in banking as a service.
Right. Not the business for you. Right. No, I think that's exactly right. I mean, I was thinking about, again, like, you have a board, you have investors that you can call, you have investors you can get advice from. You're keeping them up to date through investor updates that you're sending.
Yep.
You as the entrepreneur, your job is reality distortion, optimism. I see the world as it should be, not as it is. Like, that's you. And the investors are investing in you because of those characteristics and their belief in your ability to transform what is today into what you see in the future. That's your job, your role. I kind of feel like, and this is what I feel like is missing at a lot of even VC firms that specialize in fintech or have a dedicated fintech practice. So not just tourists who kind of jumped in and have already jumped back out. Even like the dedicated firms, a lot of their investors, by the nature, I think, of their success and their experiences in the industry, they're not very good at looking around corners and seeing problems, right? And I feel like that's the role that a lot of these fintech companies, particularly as they scale up. So like, you get past pre-seed, you find product market fit, and then you're starting to think about like, should we put transaction monitoring in place? The bank already supposedly does transaction monitoring. Do we really need our own system for doing that? Like, someone needs to be able to look around the corner and say, 100%, we absolutely need transaction monitoring. Yes, it's going to throw off a bunch of alerts. It's going to slow down certain transactions that our customers want to make. It's going to generate a certain amount of friction. We're going to have to invest in customer service in order to deal with that friction. All of that will be worth it, because what we can say definitively, having experienced this industry, having failed in this industry, having had regulators shut me down when I was trying to do something, is regulators are undefeated in this industry. They will always eventually catch up to what you're doing. And taking a shortcut here buys us something in the short term and creates a huge existential risk for the business in the long term. Don't do this. And I don't get the sense that a lot of these fintech companies are getting that advice, despite the fact that they have brand name investors on their board who have these tremendously great looking financial services recipes and fintech resumes, I should say, where they look impressive. They have these great exits. I kind of think in fintech, founders maybe idolize the wrong types of ex-founders. And maybe I'm preaching to the choir here, given that you have killed something in the past, but like, a lot more lessons to be learned from someone who's failed, I feel like.
Well, it's all the more reason why, I am a shameless QED and especially Frank Rotman fanboy.
Me too.
Right? They have run these things. They take the long view. They understand that, hey, you cut the corner. Eventually, like, that corner is going to bite you in the ankle or the shin, right? The next time you try and round it. That there is no shortcut.
Yep.
I absolutely think the industry needs a reckoning on the venture side around who is a thoughtful and pragmatic investor, not a momentum investor.
Yeah, I totally agree. And I feel like we are entering an era of fintech and fintech investing where at least the founders I talk to, and you probably have similar conversations, They are being more thoughtful about that in terms of like who are the right people to get as investors. I mean, investment is so hard to get, I think, for fintech founders now, that ones that have the right combination of characteristics that are going to attract investment, they're being a bit more thoughtful about who they want to have on their cap table. So I am optimistic that this one might start to shift, but that's definitely something I've been thinking about. Jason, I think we have time for one more question. I'll give you the honor to you if you have one more that you want to share with us.
Oh, man. This one might take us longer than we have to talk about. So the regulators took the wait and see.
Yes.
And the question I pose to you is, how do regulators get us out of the corner that we've gone backed into?
Oh, my. That is a good question. How do the regulators get us out of the corner that they've backed us into? Well, I think, again, the starting place to hit a theme we've already talked about a little bit is starting from the position of fintech is a net positive for the industry. And so whatever approach we take from a regulatory perspective needs to acknowledge that, and it's funny, we don't really have this type of regulatory focus in the US, but they have it in the UK and elsewhere, but they don't really have it in the US, which is pro-competition regulation, right? You see it expressed a little bit in Chopra's CFPB, but I think part of where we need to start is competition is a net benefit for the ecosystem. For consumers, it makes banks stronger. I think actually, speaking of banking as a service, is a big revenue lifeline. So if you are a regulator that's sort of pro the existence of community banks and protecting community banks from consolidation, banking as a service is a benefit that way too. So I think we need to start from the position that fintech is a net benefit to the industry, A. And then B, I think we need to start from the position of consumers are making rational choices. And to me, those two things need to be the foundation for how we start to back out of the corner that we've gotten. And what I mean when I say that is, I'll give you a specific example. I was talking to a regulator, a federal regulator, and they're working on the policy side, trying to figure out, like, from a rules and a guidance perspective, kind of what we should do. And in response to some of the consent orders that banks have gotten from federal regulators, they asked me a question that I thought was really telling about how they were thinking about the ecosystem, which is they asked, why are banks still getting into banking as a service? And that was a scary question to me to get, because I think the way I interpreted them asking it was, haven't we done enough with these consent orders to send the message to any banks that are on the fence about banking as a service that they should stay away from banking as a service? Obviously, they can't outlaw banks from doing it, but haven't we made it clear through our enforcement actions that we don't think this is a good idea and you shouldn't do it? And that, to me, is digging us further into the corner that we've gotten, not backing us away from it. And so I think from a regulatory perspective, the mindset shift I want to see is these are good things that exist in the ecosystem. These are things where we want to distinguish between good actors and bad actors. And the incentives that we put in place or that we encourage should allow for the separation between good actors and bad actors. And so I don't know that I have a really specific policy point. There's definitely some ideas I've kicked around in the newsletter, but almost more philosophically, I think that's kind of how we start to back away and get out of that corner. What do you think about that?
One, I think regulators need to quit being on the passive aggressive side, right? Which is we would encourage you to not do BAS. Like, you dropped the F-bomb earlier, so I can now. It's like, there are banks they should just look at and be like, that's a stupid fucking idea.
Totally.
Right. Like, no. Like, no.
This is a bad, you have 48 employees. Do not do this.
Right. And then there are the banks that are doing it well, that they need to change the demeanor and become partners too, right? Like, they need to be a little bit like heavy-handed on one side and less heavy-handed on the other to say, like, okay, let's go. You've made the necessary investment. You have earned the right to be here and to be doing this.
Yeah.
Let's go figure this out together in how we're going to do this, because it's serving a different part of the market.
Well, and there are consent orders and different regulatory actions you see where it's like, okay, we get it. You know what I mean? Like, I've seen a few over the last, year and a half where it's like, you made your point. You know what I mean? And so I do definitely feel like it's funny, right? It's like, I think what we're almost arguing for is more of a qualitative approach in some ways to this than a quantitative one. And obviously, regulators use numbers, they have data, they have scoring systems and ranking systems, and they evaluate these things based on frameworks. But to a degree, and I completely agree with this, you have to kind of make qualitative judgments about these people, whether it's a fintech company or a bank or whatever. They're trying to do this in the right way. And yes, they've made some mistakes.
Yes.
We are going to help them try to understand the mistakes they made. We're going to make it clear these mistakes are unacceptable. They're going to fix it. But we're not going to be dicks about it. You know what I mean? Like, we're not, like, these are good people trying to add value to the ecosystem and trying to solve problems. And they're trying to do it in the right way versus, and I think we all know these banks and these fintech companies, we know them when we see them. There are just bad actors in the system that habitually take shortcuts, that don't do the right things, that aren't trying to do it in the right way, that are really arrogant about what they're trying to do or their right to do it. And I'm okay qualitatively with coming down harder on those institutions. And so I do totally agree this whole, like, we don't like this categorically thing that's been happening on the regulatory side. It's not helpful.
I would add, like, one finer point, which I'd say there are bad actors and there are lazy actors.
Oh, that's a good distinction. I like that.
Right. They both need, like, a smack on the head,
Yes.
but for different reasons and different severity.
Yes. And maybe driving to different outcomes, right? Yeah.
Yeah. One gets a spanking, one gets a timeout.
I love parenting analogies. No, I think that's exactly right. I mean, the timeout that was serious. You need to go think about what you've done. You need to go into your room.
Yep.
But, like, yeah, you can come back out. And then there are ones where you're just like, nope, this is not going to work for me. Like, that's completely and utterly unacceptable behavior. And I don't see that level of gradation, I guess. And it's hard to say because a lot of this stuff happens behind closed doors. It's not always evident to us on the outside. But just from what we can see, and I think the conversations that you and I have with folks in the space, it doesn't seem like there's that gradation in the way that enforcement and supervision is done today.
Well, and part of this comes back to where we started, which is fintech is not BAS. BAS is part of fintech. We can't throw all of this into the same space, right? Like, it's very different to be doing a lending program where someone's originating, but to your standards, right?
Yes.
You're underwriting,
Yep.
and you're willing to make and carry the loan and bear the risk for it.
Yep.
Versus somebody else is using your charter to run and operate deposit accounts that you have a little oversight, right? Very different risks.
Totally. No, and being more sensitive and sort of granular to those differences, I think, would be a huge net positive for the ecosystem at a time when, as we've said before, less venture capital, less of that sort of ZERP mania, fewer tourists. Like, I actually think this is the perfect time for a more modulated approach on the regulation side, because I do think the audience of folks on the bank side and on the fintech side, it's the right group to sort of work in a more measured way with.
Yeah. Hey, before we run out of time, I want to thank our sponsors one more time. Thank you to the letter F, the letter A, the letter F, and the O, because the problem is we don't, as an industry, have the latitude to keep effing around and finding out that if we are going to better serve customers, and that is both consumers, small businesses that are underserved, the changing complexity for larger businesses that are operating in different ways, ensuring the safety and soundness of the system, we need to focus on the finding out and less around the FA side of the equation.
I could not agree more, and that is a great place to leave it. Mr. Henrichs, we will have you back sooner than we did last time. Thank you for forgiving me.
I've earned my way back.
You have. That was fantastic. Thank you, sir. We'll talk to you soon.
All right.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.